students and my friends. Today I'll speak up regarding a very important topic, ratios. Myself, Ratan gangopadhyay, again has come back on behalf of RGEM to spell the ratio analysis. Why do you go for ratio analysis? Once the profit loss account balance sheets are available, you can see the balance sheet figure, various assets there, profit loss account, sales there, net profit there, gross profit high. So everything okay. Why do we need this? We have to understand. Now the ratio analysis is most frontline analysis tool for interpretations or for comparing financial management technique, the most simple technique which we are using. Now I say, what is ratio? By ratio we mean comparing two values, but strictly speaking, for accounting or account people or account professionals, an accounting student, by ratio we understand, ratio analysis we understand comparing two financial values. Financial values from where? From there, here? No. Once the presentation has been made in front of you, you see the balance sheet, you see the profit loss statement, that is P&L account and trading accounts. You pick up any two values and compare between them. So it can be compared in ratio like 2:1 or say 5:3. It could be like 0.53, that is in fractional value, or it could be like 20%, 23%, or you can say 22.5%. So we can spell in ratios, in percentage. We can spell as fractions. We can spell in ratio like 5:3 or 2:1. Now, why the ratios? Once trading account in front of you, profit loss account in front of us, balance sheet in front of us. Why we are going for ratios? Balance sheet giving us the true positions or the financial positions of any company, firm's business, enterprise on any particular date. We understand the capital, we understand the liability, long term, short term, we understand the assets, fixed asset, current asset, and other asset like fictitious asset. We understand the current liability. Then why it is necessary to go for ratio analysis? Ratio analysis is necessary because we want to interpret result further. Suppose if I say company 1 and the company 2. If I say the company 1 and company 2 sells 5 lakhs, sells 1 lakhs. The company is good with more sales. Company is only 1/5 times the company 1. If I say the net profit, again say the gross profit. I put first gross profit, GP, then NP. GP I put here 2 lakhs. That is 50,000. GP is high, GP is low. 50,000 net profit, 25,000 net profits. By looking simply, I can say this company, as per financial statement, that is trading account, we are finding better profit, gross profit. In profit loss account, we find better net profits. But is it true? We can analyze this by ratios only. By observations, we will find this company is better. 5 times sales, GP is 4 times, net profit is double. So we will say this company is better. But is it company is doing better? Or this company with less sales, 1/5 of sales, 1/4 of gross profit and 50% of net profit is doing better or not? Only possible through ratio analysis. So ratio analysis is a technique, simplest technique in the financial management. I'll spell the financial management totally A to Z. This is the simplest technique I am using. Ratio can be classified on positional statement basis or profit loss statement basis, or mixed of one item from position statement, that is balance sheet, one item from the profit loss statement. Ratio can be put in front of you behavioral. Here I will spell the ratio. In terms of liquidity, in terms of solvency, in terms of profitability, in terms of activity. Now, a single ratio is not having for any particular firm or company any implications. When you compare at least 2 ratio or more ratio, either for a same company over the years, then we can find out whether improvement is there or there is no improvement or deterioration there. Or in the same industry, 2 companies or 2 enterprises, we compare, then we can find which companies are doing better. So simply gross profit, net profit will not interpret you more precisely which is better one. If I ask somebody is doing accounts, which company is better? This company is better, 5 lakhs. This company is better, 2 lakhs. Gross profit only 50 lakhs, 50,000. This company is better, net profit twice of this. So here sale is company 1 5 times than company 2. Here gross profit is 4 times. Here net profit is twice, double. Is it the company 1 is doing better? I will say no, because as soon as I see the figures, so myself, I will try to find out the GP ratio and NP ratios. And whenever we compare the GP ratio means gross profit divided by turnover or revenue from operations into 100. company 1 is gross profit 2 lakhs divided by 5 lakhs into 100 is equal to 2 by 5, 250 into 100 is only 40%. Here gross profit 50,000, turnover is 1 lakh into 100, so GP ratio become 50%. That means whatever good you sold, 50% earned as gross profit. Here only 40%. So you are earning more profit, gross profit, into the company too. So merely looking at the figures, we cannot decide. We have to apply the financial tool ratio analysis to find out which company is better. This company is better. 50% keep. 100 rupees sold, 50 rupees earned. 100 rupees sold, 40 rupees earned. That you have to understand. Then NP ratio. Net profit by sales into 100. Net profit by sales or turnover 5 lakhs into 100 is 10%. Here NP ratio is equal to net profit 25,000, turnover 1 lakh into 100 is equal to 25%. Now gross profit, we know difference between the sale or turnover and cost of goods sold. Obviously cost of goods sold should include the direct expenditure and direct losses is there. Net profit means considering all expenditure and losses of the enterprise, and then sales is all expenditure, all there are direct as well as indirect. Deducting, we get the net profit. Calculation of operating profit, which comes in between these two, I will show later on when we will calculate the profitability ratios. So today, before going to explaining the liquidity position of a firm and the various ratios which we must calculate, here I should say some words. The ratio analysis is a tool where by seeing or looking into merely profit loss account statement, position statement, that is profit balance sheets, looking in the asset value, looking in the liabilities value, capital structures, we cannot interpret very correctly. We can have a overview of the firm which company is bigger, that is there with the more manpower, more material, machinery, etc. But truly speaking, which company running more efficiently only understood by you when we apply the simplest tool, the ratio analysis of the financial management. This is the simplest tool. Ratio can be classified behaviorally, ratio can be classified position wise, there is position statement ratio, profit loss statement ratio, behavioral wise also we can find out, and then functional classification. Here I am going only for the functional classification. After classifying the whole functional classification, I will pick up under different head and put them under behavioral and then position wise. That I will do later on. So ratio becomes very acquainted with you. Ratio analysis is most simple tool. Single ratio is of no meaning. ratio compared for any particular firm over the period of time, showing either efficiency increased, decreased, ratio between the two firms in the same industry will show the which firm more efficiently running. Ratio analysis is time consuming, but management interested in the time consuming part because it will either save or take the safeguard of the business to perform in the next coming times. Next, looking forward, they will be more efficient. They will try to rectify their error into the operations. So ratio analysis is a tool which we must apply, although time consuming, although it is expensive, although it will give more expenditures, and like you appoint someone and some manager will start interpreting the firm's performance last few years, and in coming years what step to be taken. Expensive, but we will do it. Why? Because forthcoming days we want to do good. Okay students, so functional classifications of ratios. Functional classifications. I interpret only functional classification, and under different head of functional classification I will pick up ratios and put, that is characteristical ratios, or the behavioral ratios, or position statement ratios. So I am going into only functional classification. Functional classification of ratio. Under functional classification, foremost or the first item we have net working capital. Next we have the current ratio. Number 3, we have the acid test ratio. What current ratio cannot say, acid test ratio will speak. Acid. When you put the acid on metal, hydrogen evaporates very quickly. The acid is very hot, quickly. With the explosion, hydrogen evaporates. So acid test ratios. Or we say the liquid ratio. Then I compare with liquid ratio, absolute liquid ratio. Then this fifth, stomach is fifth. Turnover ratio. Other ratio I will speak tomorrow. Now one by one, net working capital ratio. You just brainstorm into it. Net working capital ratio. Net working capital is vital. Very vital. Current ratio, which cannot be predicted by net working capital of any company, firm, enterprise. will be predicted by the current ratio. Current ratio cannot predict something more precisely. Acid test, acid put in metal, hydrogen evaporates. So acid test ratio or liquid ratio. Then absolute liquid ratio will again interpret the liquidity. It's better or not. Then the turnover ratio. Some accountant or the expert, they take this as turnover ratio under the activity. Here I take it under liquidity ratio. These all 5 items are liquidity. So liquidity ratio. This is A, liquidity ratio. B will be the solvency ratio, the capital structure ratio. C will be profitability ratio. D will be activity ratio. Under D, some accountant they take this, some expert, finance expert they take this, or some other like me they take this into liquidity ratio. Turnover ratio, cost of goods sold divided by average stock. Turnover ratio more and more. 5 times, 6 times, 7 times, 8 times, 10 times. Your stock are very frequently converted into your cash and cash equivalent. So turnover ratio more indicating. Turnover ratio is the cost of goods sold, that is opening stock plus purchase plus direct expenditure plus chargeable expenditure minus closing stock in your hand, that is cost of goods sold divided by average stock, that is opening stock on the beginning date of the accounting plus closing stock divided by 2. If it is small turnover ratio, your stock, whatever stock you employed, money engaged into that current asset is being converted very quickly into cash or cash equivalent. So turnover ratio you understood. So I must say CGS, cost of goods sold, divided by average APG, stock. If it is more and more, 5 times, 6 times, 10 times, 13 times, 12 times, every month average stock being converted into cash equivalent. Turnover ratio is so well. Absolute liquid ratio. What are the absolute liquid asset? Cash and bank. Money in hand and cash and bank. That is cash plus bank. Cash plus bank. That is cash and bank. Bank balance, it should be positive one. Divided by current liability. Cash and bank, if at least 50% of your current liability, your absolute quick ratio liquidity is good. That is, it should be 2:1. Now, acid test ratio. Acid test. If we put the acid into the metal, hydrogen evaporates quickly. Acid test ratio. Acid test means, or the liquid ratio means, now out of the all current asset like stock, debtor, prepaid expenditure, accrued income, cash in hand, cash at bank, bill receivable, everything, short term investment. Now we look into and find out the closing stock or the stock in hand may not be ready to be converted into ready cash. It may take a little bit more time, or the prepaid expenditure which you have made in advance may not be available in your hand till the period come for which you have expended. So current asset you understood. So current asset, from there, all current asset, from there we will deduct two items. One is stock in hand, that is stock. Another will be stock prepaid expense. Prepaid expense. If we deduct those two items, prepaid expense and stock, from all current asset, and then we compare with the current liability, we have that asset test ratio. Standard format should be 1:1. Now here, liquidity ratio means how the firm is efficient enough to pay off the short-term liability. That is the liquidity. Liquidity ratio, asset test ratio 1:1 means current liability can be paid 100% anytime. Current liabilities are the current obligation which you have to meet within very short period of time, say maximum of 1 year, or say within a year. I can say 6 months maximum to 9 months. So at asset test ratio 1, so student, you must can take note of all this. You can pause the video, write down all formulas. Current asset simply means, current ratio means current asset by current liabilities. What are the current assets? If I pick up one after another, short-term investment, closing stock, stock sold on credit, debtor to bill receivable to prepaid expenditure, accrued income, and then thereafter cash in bank, cash in hand, prepaid expense, everything. Current liability are the liabilities which you have to maintain in a very short period of time. That is creditor, bill payable, outstanding expenditure, income received in advance. Now, current ratio over, now the net working capital. Last one. Net working capital, say Farm A, Farm B is there. Here, 1,80,000 is current asset. Here, 1 lakh only. Here, current liability, say 1,20,000. Here, say 50,000. Here, current asset of Farm A minus current liability, or you may say here, say 20,000. Here, working capital, current asset minus current liability, working capital by, we understand current asset minus current liability. So it's become 60,000. It's become, we take 40, say 60,000. We say the working capital employed equal, so firms are active equal to pay off the current liabilities. Now here the current liability 40, so 3 times for each 2 times current liability they can pay, but here only 50% of current liability they can pay. So 6 months at least they must take. So only by working capital, by comparing, we cannot say which company or which firm is doing better or having better ability to meet the short-term obligation, that is the liquidity ratio. So liquidity ratio of any enterprise, we understand how the firm efficient enough to pay off its current obligations like outstanding salary, outstanding wages, payment to creditor, bill payable, etc. Okay, thank you guys. Tomorrow again I am coming with the capital structure ratio or debt equity ratio. I am going functionally. So next I'll come with the profitability ratio. Next week come up the activity ratio. I'll try to finish up by tomorrow, or might take the day after tomorrow. And you can follow me in fund flow statement. In fund flow statement, I'll be doing here some CA final examination. Let us find out previous year that I will be solving here. Thank you. Myself, Ratan Gangopadhyay. Say you good night. Try to remember all the numbers. Thank you. Good night.